questions periodically as we're going through some of the material. Please just stop me right there, ask a question. It is going to be a little bit high level, as much as we can in the short time that we have this morning. So, but I appreciate your time, appreciate you showing up this morning. As the title says, we're going to just talk a little bit about equipment acquisition. So my name is Robert Hughes. I do work for Caterpillar Financial Services Corporation, so I do work for Caterpillar. We have a finance arm, and that's where I work. I was asked to present about some of the options that are available to the industry and to the customer base, and that's what I want to talk to you guys about this morning. So please, it'll be high level somewhat, but we'll also talk some different things that are out there, products for you to consider and look at to acquire your equipment needs. And if you do have any questions throughout, please just stop me and ask me. And there'll also be some time at the end as well if you have something else that you want to ask. So high level, this is kind of what we're going to talk about this morning. So I just want to talk a little bit about maybe why companies and businesses finance the equipment. What are some of the reasons behind those decisions when they look at going down that path? Talk about your choices that you have out there. So there's really two main choices, but there's a lot of institutions that do this, provide this service across the globe. A little bit on some of the high-level products that are available that are typical within the equipment industry. We'll go into a little bit of those. And then go into the 4 C's of credit, as we call them within the industry, and it really kind of relates to those 4 C's on making that decision on products and what the institutions are looking at. And it's really pretty much the same across the board. It doesn't matter if it's in the U.S. or Canada or France and Germany. When I spent time over international working with customers there, this high-level information is really the same across the board for all lending institutions and kind of the things that they look at in general for you to consider. So why do people look at financing equipment? Well, first and foremost, one of the main things you've got to look at in your business when you're looking at equipment and what you want to do is, do I want to pay cash for it or want to finance it? It's understanding what's our cash flow. As we all know, we're looking at our business, looking at our day-to-day operations. I'm trying to manage my cash flow. Financing the equipment is one way to do that, where you can help manage your cash flow. We like to say in the industry, as we always do, they say cash is king. That's true, but we know there's a lot of cycles within our industry, up and down. For example, we're kind of in one now where the cycle's down a little bit with it. Maybe it's not a good idea to maybe take the cash we do have in reserve and when we need to place equipment and spend that cash today. Maybe a better alternative to keep that cash because we're not sure how long this is going to take or do is to maybe to finance our equipment acquisition that we're looking at so we could manage our cash, maybe take advantage of an opportunity that's coming out that we're seeing or coming out in the horizon. I want to save that. I know something's going to turn around and do, so I want to try to manage that cash flow that I'm doing. And especially right now as we're in one of these market downturns a little bit, can really help you keeping some cash on hand and do it. The other thing is as businesses grow, as we grow, whether it's in our business or in our own personal times when we're looking at growing our credit, it's really to grow our borrowing capacity. As we say, credit is what's used, whether it's in business or personal, to acquire things. I want to buy a house, I want to buy a car. What's the first thing they ask you? What's your credit rating? When you're looking at growing your business and growing assets and trying to take advantage of market opportunities or things that are out there, you've got to look at your borrowing capacity. How can I do that? And lending and borrowing is a way to do that, and that's what institutions look at to do. You want to try to get some credit and grow that in a way that allows you to continue to grow your business and really borrow more in the future. And honestly, almost every company out there borrows in some form or fashion. It really doesn't matter the size of the company, but it's understanding that and trying to get you to that level. So that's kind of why we look at financing our equipment. The other thing is we talked about cash a little bit ago. Cash is there. Sometimes we have it, sometimes we don't. So borrowing to acquire that equipment, it does allow us to conserve that cash and hold on to it. And all manufacturers, like we do, as do our competitors that we know are out there in the marketplace, we do offer offers for equipment periodically. And most of those offers, when manufacturers do that, is a financing type offer to do that. So they have offers out there for you to buy equipment, take advantage of that financing offer to do it. And it's really just not in our world of equipment. It's in all products that you see. If you go out there today, if you want to go buy appliances or something else, they all offer offers to you to buy their equipment. That's what manufacturers are trying to do to sell it. And almost every one of those offers usually is a finance-generated type offer out there. So that would be one of the reasons that you would look at financing equipment to do that. Any questions on that so far? Okay? So, a lot of financing institution choices that we have available to us when we're looking at finance equipment. First and foremost, the one that everybody really knows most about, banks. Banks are out there, definite need of our economies across the globe. Also a little bit of reason we got in trouble a few years ago with what they're doing. But banks serve a need. One of the primary things that they do for us, they take deposits. That's what's making them unique from other lending institutions. They take deposits. That's good. We need them to do that. They do a lot of stuff for us. However, they are heavily regulated as well across the globe. And in some countries, a lot more than in the U.S. and Canada at times. So they serve a purpose. They do a lot for us. They're highly regulated. They're also highly diversified. And what I mean by that is the bank's going to offer lending for equipment. They're going to offer lending for real estate. They may do stuff in aircraft industries and medical industries. So they're going to be highly diversified in a bunch of different industries out there. That's what they do. They've been around for a long time. The good thing from a lender, if you're lending and you're part of a bank, you can weather these different cycles because there's so much involved in other different industries, this and that. So if one industry's down, hopefully 3 or 4 other industries that they're working in are highly up. So it's really something to look at on the way they go to business and they look at doing things. But they do a lot of services that we all use and need every day. The other ones are finance companies in general. So there are a bunch of other finance companies out there in the market today that are not banks. We do not take deposits. Our company is one of those. We are known as a captive finance company out in the marketplace, meaning that it's a finance company that's owned by a manufacturer out there in the marketplace. We have it. Almost all of our competitors have it as well. Almost all manufacturers of other goods and services have a finance type company out there available to help sell their products. And then there's other independent finance companies that are available who aren't really tied or associated with any sort of manufacturing type entity making products out there. So there's a lot of choices to do that. Now, what we have to look at and understand is whether we're going to look at a bank or we're going to look at an independent finance company is how similar they are and how different they are in doing it. What type of fees are involved in that lending? So fees is a big part of lending for a lender. What am I going to charge the borrower coming to me? What am I going to charge him for doing an origination of the financing arrangement? Am I going to have a fee in charge with maintaining that financing relationship? Am I going to have a fee for that borrower if they decide to pay off early with me? Am I going to have a fee for that borrower if I need to do some sort of restructure or modification? What does the Lending Institute do if we end up in a downturn like we are a little bit today and we had some financing arrangements with our lender, whether it be in a bank or a captive finance company? Will they help me out? Will they help me modify the lending transaction that I have? Will they help me restructure my debt that I have today to help me weather the storm? Are they willing to do that? Are they not willing to do that? We have seen through the ages and through the years, they all will do it. Banks and all independent and other captive finance companies will do it, but some of them are more willing to do it than others in certain industries at times. We've seen that time and time again. I've spent a number of years within the lending industry and been at different organizations, so you can see where sometimes we have the appetite to do it, sometimes we don't to do it based on what their needs are, based on their diversification that they're looking for. The other things you want to look at when you're looking at lending is we've talked about fees, we've talked about modifications, restructures. How about repayment of our transactions? In the finance world, and most people talk about typically monthly payments. The terms are typically on an annual basis, 12, 24, 36, 48. Very common terms that are out there. It's kind of the standard of the norm. But will they do something different for me? Say I don't want to do 24 months. I want to do 30 months instead of 2 years. I don't want to go a full 3 years. I just want to do 2.5. Will they do 30 months for me instead? Will that institution do that for you? You have to ask them and find out. Maybe I'm in an industry and a business that's has a little bit of cycles. I need some skip payments, or I don't really want monthly payments. I want to do quarterly payments or semi-annual payments. Will they do something like that for me? These are questions that all institutions will pretty much do that, but you have to ask. Sometimes we just get to the fault and the habit of they're just going to propose monthly payments. They're going to do a 2-year or 3-year transaction arrangement and do that. But there's a lot of different flexibility and options out there to do. The other thing they look at, you need to look at with them is Are they going to ask for additional collateral, as we say in the lending environment? So our main piece of equipment is usually collateral, but when they're looking at it, and we're going to talk about that here in a little bit, when we get towards the 4 C's, is there something else that they want from me? Is there something else when they're looking at my credit rating, they're looking at my balance sheet, financial statements that I'm providing to them, are they going to want something else additional that they want to do? Do I want to give that up to them as a borrower? Do I have anything to give up to them as a borrower? Are they going to go take a blanket? Some institutions go out and will take a blanket over all the equipment that you own when you do the lending. Now, they're supposed to tell you that they're doing that. You've got to get some permission, but you've got to be careful of some of those that may do that and you not necessarily know that it happened on the back end. So that when you go to borrow additional funds for something else, whether it be equipment or expanding your business, and you find out you have assets that are all tied up with it. They put liens on them. So there's different things that the institutions will do that you really need to understand and ask them to do it. And please don't be afraid to ask them those questions. Ask them, what type of fees are you doing? What type of collateral are you looking at for me to do with it? Is there something else that I need to know about? If, let's say, I had trouble paying, do I have a grace period in your note? So the payment says I'm due on the 1st. Do I have until the 10th in case something happens? I'm waiting on a payment to come back on some work that I'm done. Do I have a grace period to make that payment on time and still not be considered late under the contract? So you need to look at the agreements, look at some of the different choices that are out there. Don't be afraid to ask some of those questions from the lender's institute that you're borrowing stuff. There's a lot of flexibility and choices out there, and some are really good, I would say. Some are pretty more strict and stringent on some of their requirements that they do. But really understand that we all kind of do the same thing that we do, but the banks are highly regulated today, so there are going to be some things that they're going to ask you to do that a finance company is not going to ask you to do in that regard. So please be aware of that with it. A lot of different things that they offer as well between the equipment financing, doing different lines of credit for different things, working capital, restructuring, refinancing debt for you. A lot of them will do that, the banks, the different finance companies as well. So it's understanding all those different things that are available for you to do to try to acquire your equipment in that regard. Any questions on that so far? You guys are going to make this easy for me this morning. This is just a snapshot. I just put a snapshot up there for you as we talked about the different choices of lenders out there between banks and finance companies. Just put a couple of logos out there on the slide to see. So as we mentioned earlier, there are a lot of choices for you to do and who you can look at. Most of the major equipment manufacturers have a lending arm that you can use, and then with the banks. And some of them are regional. So you may see some that are quite national in names, and then you might see others that within whatever region that you're located in the country, maybe they're just more in a regional location as well. But you have a lot of choices out there. I wish I could tell you the total number, but I do not know. I just know it's in the thousands. Even with all the consolidations and things that have happened the last few years, smaller ones being bought up by bigger ones, regional ones buying other regional banks, there's still thousands of lending institutions available out there for you. All right. When we're talking financing products of equipment, we're really there's a couple of main ones that we really see a lot. So the first one is purchasing, really being a loan. That's what I mean by purchasing. The typical loan that's out there today in the lending environment, the loan's been around for a long time. Most of us have it on our homes and vehicles. That's a common practice for our equipment as well. You financed your equipment purchase, you set it up on a loan. At the end of that term, whatever that term was, you pay it in full. So your payments include principal and interest, so you're building equity into that product that you're doing. Sometimes there could be down payment in there as well with it that may be required or that you wanted to provide as well. When you provide down payment, it reduces the amount that you're borrowing, helps you build up some equity a little bit faster as well. Loans go on our balance sheet, so when we're looking at putting that asset and acquiring it, it goes on our balance sheet. So as the borrower, I have that piece of equipment and stuff on my balance sheet. I'm allowed to take depreciation now for that equipment, so there's some positive things that also helps grow my borrowing capacity because now I have that asset and liability, and usually the value of the asset is greater than the liability. So in the equation, your equity now is growing as you do that. So it's a very common practice to do loans. A lot of people do loans. A lot of lending institutions, really, as they look at their portfolios, are heavily weighted towards loans. It's just a common thing that people want to do. They want to, when they buy equipment, they want to own it. They want to, when they get done paying it, they want to have it paid in full and not have anything done with it. Now, please bear in mind that when you do a loan and when you come to the end of the term, the institution is supposed to release the lien on that equipment. So most are pretty good about doing that. Some take a little bit longer than others to do that. Some sometimes forget with it. So if you do purchase your equipment and you do as a loan, and if you did a 3-year or 5-year term, at the end of that term, always make sure a few months afterwards that you check and make sure that you've got that lien release document from the lending institution, because the collateral is probably their primary collateral is that piece of equipment that you've done and got the borrowing on. You need to make sure that they've released the lien on that, so that you are now the true lien holder of it. Because when you borrow money from a lending institution, they're the lien holder of the equipment at the moment until that debt's paid in full with it. So please be aware of that. That's something very important. We have seen that a lot through the years within the industry, working with various customers.